Hello and welcome. My name is Connor Marsh with Excalibur Financial Services. We are a Jacksonville, Florida-based money management firm whose founder, Gary Marsh, has been in the business for over 35 years. Today, we'll be discussing a quick economic update in light of a lot of the recent market volatility we've seen and kind of discuss a few things that we find interesting in detail. Most of the data today is being provided by our friends at JP Morgan Asset Management. We always find the information they provide to be accurate, helpful, and informative. So this is the weekly market recap, which is really just a snapshot and metrics of the economy and of different financial markets around the world as of October 29th, 2018. Today we'll just be taking a quicker look at some of the different sections that we find interesting and kind of adding some detail on those. Here we can see the equities market, and for interesting things to look at would be the 1 week number here. We can see that across the board, S&P 500, Russell Growth and Value, International, Emerging Markets, NASDAQ are all down for the week and for the quarter basically being just the month of October so far. And even some of these numbers, even looking at the S&P 500, down over 8.5%, bringing their year-to-date number to just under 1% for the year. Growth is still positive, right along there with NASDAQ. A lot of these large Russell 1000 growth companies are tech-oriented, and also, as you know, the NASDAQ is a tech-based index, so it makes sense that those two indexes are still up for the year. International and emerging market sectors, we can see for the year they are down 10 and just under 17% respectively. These two areas and sectors were one of the top performing asset classes last year, but have struggled this year, we think mainly due to talks of trade tariffs between the U.S. and different countries around the world, and also the strength of the U.S. dollar has a large impact, especially on the emerging market economies, as much of their debt is denominated in U.S. dollars. However, we feel that a lot of this volatility across the board is due to some concerns that the economy is overheating, possibly. Again, as I mentioned before, trade tariffs, the possibility that the Federal Reserve is tightening too quickly, which I will touch on a bit later on in this video, and also the possibility that these equity markets are slightly overvalued. So the defensive adjustments that Excalibur made to our managed accounts earlier in the year have really proved to be timely in light of this recent volatility. Here we can see the different sectors of the S&P 500 broken by side. I think a couple to take note of is the technology sector here, up just over 9%. A lot of that sector is made up of those large FANG stocks that you are very familiar with: Facebook, Google, Apple, Amazon. Companies like that have done extremely well lately. Looking at utilities, utilities have done well historically at times of high volatility. Investors see utilities as somewhat of a bond proxy in that they pay their high, consistent dividends. So to see them doing so well in 2018, when we've seen a lot of volatility, does make sense. Another one to note would be materials. Down here at the bottom, I think the materials sector has been hurt quite substantially from the tariffs on aluminum and steel and other products around the world. We think of companies like Caterpillar, heavy equipment companies, materials companies that are now having to pay more for their equipment, and their materials to make their equipment are really hurt the most. Looking over towards fixed income, weekly number, all positive across the board except for high yield. we like to think of the bond portion of the portfolios as being there to help provide some ballast. Typically, bonds are negatively correlated with equities. So if we think back to one of the first slides we looked at, the 1 week numbers on all the equity indexes were pretty far down. So when we look at the 1 week on the fixed income side, and we see that the U.S. aggregate, U.S. corporates, and municipals are all positive for the week, it makes sense. High yields typically provide some downside protection, but then again are more often than not more closely correlated to equities. So in saying that, when equities go down, so do high yields for the most part. Here we can see U.S. Treasuries. If we look year over year, these numbers are as of just this past week versus the end of 2017. Looking at the 2-year number, we can see in 2017 we're at 1.89 versus 2.81. On the 10-year, 2.40 versus 3.08. And on the 30-year, 2.74 over 3.32. So you can see those rates have been steadily climbing over the past year, mainly due to the Federal Reserve's 3 interest rate hikes in 2017, 3 more in 2018. They're currently predicting 1 more to come before the end of the year. And then looking ahead, we're anticipating 2 to 3 more rate hikes moving forward. You can also see these interest rates have also affected the 30-year fixed rate mortgage year over year, especially if you look back. Again, steadily climbing, even looking years backwards. Overall, we are cautiously optimistic looking forward for a couple reasons. Number one, GDP growth has been at some of the highest levels we've seen in a while. And secondly, companies are continuing to report very strong earning numbers due to healthy revenues and healthy margins, which is really a continuation from the strong earnings reports we saw being reported last year. So that's the end of our quick economic update. Hope you find this helpful, and we will likely continue this moving forward on a quarterly basis, or unless we see something interesting in the markets, and we will of course pass it along to you. Again, my name is Connor Marsh with Excalibur Financial. Please feel free to reach out with any questions about today's video or any other financially related questions you might have. Our number is 904-619-5944 for our main office line, or feel free to visit our website for more information. Thank you, and hope you have a great rest of 2018.